All right, if you're watching markets right now, stop scrolling for a second because something just snapped. I'm talking about silver losing 34% in a single day. 34. That's not a typo. That's the biggest one-day crash in silver's recorded history, and it happened fast, violent, and almost nobody was prepared for it. Nearly $1 trillion vanished from gold at the same time. And here's the part that matters to you right now. The real trigger isn't what headlines are telling you. Stay with me because I'm going to show you what just broke, why it keeps repeating, and how you can spot this pattern before it hits again. Before I explain what caused this move, let me teach you something most people don't fully understand about silver pricing. When you see a price on your screen, you assume that's the price of silver everywhere, right? But that's not actually how this market works. Think of silver like a concert ticket. There's the digital resale market where tickets fly around endlessly, changing hands dozens of times, and then there's the actual seat in the arena. The physical thing. Those two prices can drift way apart. Silver trades the same way. Most of what you see traded every day isn't physical metal. It's paper contracts, promises, IOUs, and those promises can multiply far beyond the real thing sitting in vaults. Now here's what you need to understand about that structure. When volume explodes and everyone's talking about silver, 98% of that action is happening in paper markets. Futures contracts on the COMEX, ETF shares that might or might not be fully backed, derivatives stacked on derivatives. And all of that can move independently from what's actually happening with physical metal changing hands in the real world. So what does that tell us? It tells us that price discovery in silver isn't just about supply and demand for metal. It's about supply and demand for contracts. And when those two markets pull apart, that's when things get really interesting. If this is making sense so far, drop a comment below. I want to know how many of you are watching this in real time. Now here's what's actually happening, and this is where things get uncomfortable. In the US, silver pricing is dominated by paper contracts traded on CME Group's COMEX exchange. Estimates put the paper-to-physical ratio around 350 to 1. That means for every single ounce of real silver that could actually be delivered, there are hundreds of paper claims floating around in the system. So when large institutions want to push price down, they don't need metal. They just dump contracts. Sell, sell, sell. And when silver becomes a crowded momentum trade, like it did this January, after surging more than 60% in a few weeks, that leverage becomes explosive. Everyone's long. Everyone's using borrowed money. Everyone thinks they're early to the trade. So here's the sequence, and I want you to really hear this. Silver rallies hard. Traders pile in using leverage, sometimes 10 to 1, sometimes more. Paper volume explodes. Open interest goes parabolic. Then, all it takes is aggressive contract selling to knock out weak hands. The price drops 5%, then 10. Margin calls start hitting accounts. People who borrowed to buy get forced to sell. Liquidity vanishes because nobody wants to catch a falling knife. Price collapses. And that's exactly what you just watched happen. In less than 24 hours, silver went from 117 down to the low 90s. That's a move that wipes out retail accounts, closes hedge fund positions, and sends shockwaves through every precious metals forum on the internet. But here's the part most people are missing, and this is critical. While paper silver crashed to around $92 on COMEX, physical silver in Asia didn't follow. In Shanghai, buyers were paying $120 to $130 an ounce through the Shanghai Gold Exchange. That's a 40% premium, two prices, same metal, same moment. That divergence is the stress fracture in the system. When you see that gap, you're not looking at efficient markets finding equilibrium. You're looking at two different realities. Paper markets are saying there's too much supply, everyone's selling, the trade is over. Physical markets are saying we still can't get enough metal, premiums are rising, and the shortage is real. Now let me show you why that should make you nervous, or at least very alert. When paper markets crash, but physical premiums stay elevated, it tells you the selling pressure isn't coming from real supply suddenly flooding the market. It's not like mines just discovered massive new deposits overnight. It's mechanical, it's leverage unwinding, it's financial plumbing seizing up. And when that happens, the paper market can temporarily overpower reality. Contracts can be created instantly, metal can't. So paper wins in the short term. But here's the thing, it doesn't resolve the underlying shortage. It just delays it. It resets the leverage, shakes out the weak hands, and sets up the next move. Think about what's really happening behind the scenes. Physical buyers in Asia are watching COMEX prices crater and they're thinking, great, discount. They step in, they buy. But the metal they're trying to source isn't sitting in warehouses waiting to be shipped. COMEX registered inventories, the stuff that's actually available for delivery, that's been trending down for months. So you've got paper price discovery saying one thing, and physical availability saying something completely different. That tension doesn't just disappear, it builds. This is the exact same playbook we've seen before. Go back to 2011. Silver ran hot, became the trade everyone was talking about, hit nearly $50 an ounce, then collapsed hard in paper markets while physical demand stayed sticky. I remember that year. Coin dealers couldn't keep inventory. Premiums were through the roof, but COMEX price cut in half. Same thing in 2020. Massive monetary stress, central banks printing like crazy, silver surges from $14 to nearly $30, paper corrections shake everyone out, and then the fundamentals quietly rebuild pressure. Every time you zoom out, you see the same rhythm. Leverage builds, paper breaks, physical waits. Then the cycle resumes when trust returns. And there's another one worth mentioning. March 2020. Remember that? When liquidity froze across all markets, silver got hammered, dropped from $18 to $12 in a matter of days. But what happened to physical? You couldn't buy it. Dealers were sold out. Premiums went to $8, $9, $10 over spot. The paper market was screaming sell, and the physical market was screaming scarcity. Within months, silver was back over $28. Same pattern we're seeing today. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this just be a blow-off top? Could silver be done for this cycle? Sure. Markets don't owe anyone anything, and not every divergence resolves higher. Sometimes the paper market is right and physical premiums come back down to earth. Could this be manipulation by big banks or institutions with short positions? Maybe. Could it be algorithmic trading gone haywire? Possibly. Here's the thing. It doesn't actually matter whether there's some shadowy conspiracy pulling strings or whether this is just market mechanics doing what markets do. The structure is public. The ratios are visible. The premiums are real. You don't have to predict motives. You just observe mechanics. You watch what's happening and you position accordingly based on probabilities, not certainties. There are probably three types of people watching this right now. The first is the short-term trader who just got wrecked and is asking, how did this happen so fast? If that's you, the lesson is brutal but clear. Crowded leverage trades snap without warning. When everyone's positioned the same way, when open interest is extreme, when sentiment is euphoric, the exit door gets very small very fast. Your job now is to figure out if you were trading or investing. If you were trading, you needed stops. If you didn't have them, you just paid for expensive education. Take the lesson. Don't take the bitterness. The second type is the long-term silver holder who's calm but confused. You've been stacking physical for years. You understand the supply deficit story. You know about industrial demand, solar panel usage, electrical vehicle consumption. And you're sitting there watching your net worth drop 30% in a day, wondering if you missed something. If that's you, remember why you cared about physical supply in the first place. Nothing about tight metal changed overnight. The paper market crashed. Your metal is still in your safe or your vault. The fundamentals you believed in last week, they didn't evaporate. The question you need to ask yourself is whether this changes the long-term thesis. For most of you, it probably doesn't. And the third type is the observer who hasn't acted yet. You've been watching silver, maybe you've been curious, maybe you've been waiting for a pullback. For you, this is tuition. You're learning how paper and physical disconnect before major moves. You're seeing in real time what leverage does to markets. You're getting a masterclass in how sentiment can shift from greed to panic in hours. Don't waste it. Study what just happened. Understand the mechanics. Because whether you buy silver or not, this pattern shows up everywhere. Crypto, tech stocks, real estate. Anytime leverage meets momentum, this is the risk. Here's where I stand. I'm not panicking and I'm not pounding the table telling you to buy. I'm watching. Let me tell you what I'm personally watching. First, I'm watching physical premiums. If they stay elevated above 5 to 10% in major markets, that tells me stress is still in the system. If they collapse back to normal, that tells me maybe the shortage narrative was overblown. Second, I'm watching paper positioning. The commitment of traders report, open interest, who's net long, who's net short. If leverage resets while price stabilizes, that's actually constructive. It clears out the weak hands and creates a cleaner setup. Third, I'm monitoring gold's response, because silver doesn't move in isolation. Gold dropped too, but not nearly as violently. If gold holds its support levels and stabilizes, that keeps the broader precious metals thesis intact. If gold breaks down hard, that changes everything. The way I see it, this crash was mechanical, not fundamental. The fundamentals didn't break. They got exposed. The gap between paper and physical, that's been building for months. The tight supply situation, that didn't change. What changed was sentiment and leverage. Those are temporary, they reset. Fundamentals take longer to shift. So if you're asking me whether silver's done, I'd say it depends on your time frame. If you're a trader, yeah, maybe this rally's over. If you're thinking in years, not weeks, then what you just witnessed was the kind of shakeout that historically precedes the next leg up. If history rhymes and silver can rebuild trust while physical markets stay tight, the move that follows could be significant. Not a prediction, just a pattern. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the Shanghai premiums yourself. Look at COMEX inventories. Read the QOT reports. Don't take my word for it. Don't take anyone's word for it. This is your money, your risk, your responsibility. If you made it this far, you're the kind of person who wants to understand what's actually happening, not just react to headlines. That mentality will serve you well. Share this with someone who needs to see it. Subscribe if you want more analysis like this, and stay ahead of the noise. Because in markets like these, understanding the game is more valuable than guessing the outcome. Stay sharp out there. Think critically. Verify what you're seeing. And always, always know which market you're actually trading.